Hello, and welcome to part 2 of my Investing Basics series. If you haven't already subscribed, please take a moment to do so, and give the bell a press to get alerted for all future videos. If you haven't seen part 1, please feel free to click the link and check it out. This video picks up right after mutual funds at the end of part 1. If you have seen it, thanks for watching. Glad to have you back. In this video, we'll go over the basics of ETFs, options, and index funds. Just like the last video, I want to state that none of this constitutes financial advice. So, let's start with ETFs, exchange traded funds. ETFs and mutual funds are incredibly similar. They're both portfolios of assets that you can pull your money into. While certain mutual funds and ETFs can be used to invest in some foreign asset classes and commodities, the main differences are mutual funds are usually traded once a day at market close and off of exchanges, while ETFs are traded daily during market hours, and their prices fluctuate throughout the day because of it. And while ETFs can be pegged to a stock index or a basket of assets, buying an ETF isn't the same as owning the asset, unlike with mutual funds, whose purchase constitutes a partial ownership of the fund's portfolio. Exchange-traded funds are also passively managed in most cases. However, actively managed funds do exist, and there is an increased price as a result. Another key piece of information on ETFs is that due to the large amount of ETFs that have started showing up since the 2008 financial crisis, some have a very low volume of investors, and that makes selling or buying shares in them many orders of magnitude more difficult. And it is recommended to do your research into the liquidity of the fund, as well as the composition of the fund before making any purchases. Options. Options are a type of contract that allows the purchaser to pay a small price for the ability to purchase a set amount of stock at a predetermined price at some later time. Options are a great way for people to hedge bets or to enter a stock position that they don't want to take a full risk on. Options can be split easily into calls and puts, with other types of options and strategies deriving from them. A call option is like calling a hit in baseball or shot in basketball. You know the price you believe an asset will increase, so you purchase a call option to buy 100 shares of Company A at $220 a share in 2 months. 2 months later, the price of Company A goes to $440. You can then exercise your options contract to get 100 shares that cost $440 a share right now for the price of $220 a share. Put options are the opposite. If you believe a stock's price will go down, you can purchase a put for Company A at $220 a share in 2 months. Then, 2 months later, the price of Company A drops to $110. You can then execute your option and sell 100 shares of Company A at $220 a share, keeping your investment safe even with the large share price drop. Now, you might be asking, what if I don't have or want 100 shares in a company? You're saying that I could pay a small price now for something that I may or may not need? Well, you're in luck. The premium paid for options is generally something that increases in value with the value of the underlying asset. If you purchase a call option for $100 and the company whose shares that option represents increases by a large amount, then the value of that option increases by a large amount as well. The option can then be sold to someone else who is looking to exercise the option, and you may make some money without buying or selling shares in the company. But it is also possible for options to lose enough value to become completely worthless. And just like all investments, it's recommended to do your own research before making any investment in options. Index funds. An index fund is a type of mutual fund or ETF. Index funds are generally funds that track indexes. The most popular indexes are the Standard & Poor's 500, the Wilshire 5000 Total Market Index, the NASDAQ Composite Index, and the Dow Jones Industrial Average. There are over 5,000 indexes to invest in. And to invest in indexes, most people use index funds. Index funds are passively managed like most ETFs, and as a result, have lower operating expenses than the majority of mutual funds. And due to index funds copying an index, a large number of them are automated and only readjust when the index changes its asset composition. Index mutual funds and index ETFs behave similarly to their named counterparts, with index ETFs having lower fees than index mutual funds due to not being actively managed, as well as being more liquid and more tax efficient. But always take caution before making any investment, and as always, do your own research. I think I'll wrap this video up here. Thanks for watching. I hope you enjoyed this overview of ETFs, options, and index funds. Please leave a like if this video was helpful, and feel free to leave a comment with any advice, critiques, or even if you just want to say hey. In my next video, I'll take a break from traditional investment vehicles and talk about cryptocurrency. Anyone wanting to know about blockchain, Bitcoin, Ethereum, and how to get your hands on some, I'll go over the basics next time. Take care, much love. Later.